All right, back again for a second stream tonight. We are definitely witnessing history. We are documenting something that many of you will never see again in the oil market. It is truly incredible. Tons of stories I'm going to talk about that have just manifested in the last week or so. You have OPEC countries begging Saudi Arabia and Russia to start cutting oil production. This article was from Grant Smith from Bloomberg 2 days ago. March 27th. So OPEC nations howl for mercy as Saudi-Russia oil war deepens. They're really going after Shale. But tonight, why I am doing this emergency broadcast is the crude oil futures contract down more than 5%. It was down, I think, more than 6% a little bit ago. It was way below, well, not way below, but still below 20 at $19.92. It is looking very likely that sometime this week, the oil market will break below $20 a barrel and will fall even lower than that. And so those of you who have been catching falling knives, trying to collect the dividends for some of these oil companies, I warned you for the last couple weeks or a month or so to stay away. I was predicting an oil market collapse about 2 months ago at the end of January when I was getting information about how bad the global pandemic really was in China and out of Wuhan, the mess with the global supply chain, the travel restrictions. I was in shock that the oil market, the prices were still so high, and also that the airline stocks had not crashed 2 months ago. So the oil market will break 20. It's barely holding above 20 right now on the futures contracts at $20.38. And a couple days ago, Nick Cunningham, who's one of my favorite oil and energy journalists at oilprice.com, the best free resource for the oil market, he put out an article that, and I think it's a very important read, that the oil majors, so your Chevrons, your Exxon Mobils, your BPs, your Totals, all the big companies are preparing for oil prices to hit $10. So the wave, I'll just read the article now. The wave of oil industry spending cuts continues, with the majors now announcing significant reductions to spending as oil remains stuck in the 20s. Remember, this was a couple days ago. Now it looks like oil will not hold 20. It is a question of when and not if. People are really worried about the demand side for oil. This is the largest demand destruction we have seen for oil, probably even more than a war effort, because during a world war, they were still using a lot of oil, although there was rationing. So oil was being massively used. The demand side of the equation for oil, for gasoline, for jet fuel has been completely and totally destroyed. Royal Dutch Shell, and who knows when things come back online. Royal Dutch Shell said on Monday, somewhat back to normal. When things come online, somewhat back to normal. Royal Dutch Shell said on Monday, so this was about 6 or 7 days ago, that it would cut spending, CapEx spending by 20%, or about $5 billion, and also suspend its share buyback plan. Most of the people who are buying Royal Dutch Shell shares now think that they will not cut the dividend. We shall see. The dividend payout ratios for a lot of these companies are well over 100% now. British Petroleum, or BP, I think has a dividend payout ratio around 200. Exxon Mobil, the last time I looked at it, this may have changed. It was at over 188%, and Exxon Mobil was looking at a second credit ratings downgrade in only a couple weeks. They are on the S&P credit watch list for a second credit ratings downgrade soon. Not a good sign. French oil giant Total and Norway's Equinor announced similar moves. ExxonMobil and Chevron have suggested they too would be axing their budgets, with Exxon under particular pressure. Again, I've outlined the reasons why with Exxon. Their dividend payout ratio is too high. It's causing financial problems at the company, and the credit ratings downgrades are serious because they are the only, I think, large oil company that's on the S&P credit ratings downgrade watch list for a second credit ratings downgrade in only a couple weeks. Goldman Sachs estimates that Chevron needs $50 per barrel in order to cover spending and maintain its dividend. ExxonMobil, on the other hand, needs something like $70 per barrel. Wow. The majors are relatively more insulated from the downturn than small and medium-sized shale drillers because they have downstream refining and petrochemical assets that have typically performed somewhat better than upstream units when prices fall. Go back and listen to the interview I did with my former coworker and oil market mentor, Robert Rapier, 25 years working in the oil industry at different companies, including ConocoPhillips. Him and I discussed the oil refining industry. The oil refiners are also getting killed. So the oil refiners, normally he is correct, Nick Cunningham and others are correct, when oil prices fall, normally demand for gasoline and jet fuel is still strong. This is not the case right now, unfortunately. So the oil refiners are also getting killed. Oil refiners are discounting their oil to get their gasoline and other products to get rid of it so they can raise cash, and they're cutting their production levels too. So they're discounting to get rid of the product they produced for cash to clear inventory, and announcing big production cuts for what they're going to produce. That's how bad things are. It is a complete and total bloodbath in the oil market. It is a falling knife. People are still trying to catch the falling knife. I am staying away. I want to see some semblance, some signs that oil demand is going to start increasing again. And you know what? Every time I check for oil stories, I read a lot of different oil articles. I don't see any evidence. There are crazy things that are happening in the oil market, stuff I did not think I would see. We are seeing also that Russia's state oil company Rosneft, this was reported by New York Times a few days ago, that Russia's state oil company Rosneft is in a very unexpected and a very peculiar move, is now selling all their oil assets in Venezuela. So not at a good time to sell for Russia. They're selling at a low price to get out of their Venezuelan oil assets. So the oil majors, let me go back to the article here with Nick Cunningham. Okay, but the majors do not have this cushion this time around. We are in the midst of a historic meltdown, a supply crisis, and a demand event with no precedent. I've studied a lot of oil market busts, a lot of panics, and I've been in the oil market now, covering it, trading it for 10 years. My day job was an oil analyst a number of years ago, working with Robert Rapier, covering oil stocks. And we had an oil market bust start 2013 through 2016, where the Saudis and OPEC were trying to kill shale for the first time. So they refused to cut production. They tried to kill shale. And in 2015 and 16, there was a pretty good amount of shale bankruptcies, but it didn't kill shale totally because a lot of shale companies survived because of how much capital was available. That is no longer the case. So I've been around two oil busts, 2008-9 with the crash after it hit 147 a barrel, I think in 2007? Maybe late 2007, early 2008, got up to 140 something a barrel. Then it crashed in the 2008 financial crisis down to 29 a barrel. So we're below that now. And remember, you also had back then, you had China coming in and paying above spot prices, very large long-term supply off-take agreements with Russia and with Brazil to help try to stabilize the market, big purchases. So there's this bust in the oil market is like nothing else I've ever studied before, and I've studied past oil panics. There is nothing like this because demand has also collapsed, and there was too much supply. And these companies, these national oil companies and these private oil companies are not cutting production nearly as quickly as they probably should. Some of them can't cut production because they have hedges, but others, they have so much debt that they need the cash flow, and they're hoping prices are going to rebound, and they're going to be producing a lot of oil up until the day they file bankruptcy. Okay, the majors do not have that cushion this time around. We are in the midst of a historic meltdown, a supply crisis, and a demand event with no precedent. I have called this the perfect storm of bad news for the oil market. Estimates vary, but oil consumption could be off by 10 million barrels per day or more. I have seen estimates out from different, whether it's investment bank oil analysts. Goldman Sachs, I think, has said that oil demand has collapsed by 20 million barrels per day. I think the head of the Energy Information Agency at the U.S. or the International Energy Agency in the last couple days said oil demand has collapsed by 20 million barrels per day. So that was their estimate that came out a couple days ago. I was talking about that on another live stream. Doesn't matter how cheap crude is if people are not driving, flying, or consuming anything aside from the bare essentials. There is no demand boost for low prices. Also, it doesn't make sense to store it because your storage costs are going to be high and the price is falling. So you're going to be paying a lot of money to store this, and who knows how long you're going to be waiting. On Monday, Exxon Mobil announced that it was cutting production at its Baton Rouge refinery, the company's second largest refinery in the U.S., because poor demand has filled up storage tanks. I also covered a couple days ago how there is almost no storage space left for oil. Almost all the storage areas are filled up. The U.S. Canceled their order. I think President Trump could not get funding from Congress for the strategic petroleum reserve purchases. He couldn't even get in the congressional bailout nonsense that the Congress put together because I think the Democrats wouldn't approve it. Okay, because poor demand filled up storage tanks, Exxon also cut 1,800 contractors from the site. In another example, a major closely watched petrochemical project in Appalachia may not go forward as the market sours. The first round of spending cuts from the oil industry is now visible, but a second round is beginning, according to a report from Goldman Sachs. Also, to be on the watch for credit ratings downgrades. So Exxon Mobil is on the list. There is not, to my knowledge, another large oil company on the list yet, but that could change depending upon how bad things get and how long this goes. So how low the oil price goes and how long this lasts until we start to have more demand restored to pre-global pandemic levels. We see U.S. oil production falling almost 1.4 million barrels per day over 5 quarters, post second quarter 2020 based on reduced drilling. Oil production is falling almost 1.4 million barrels per day over 5 quarters. Post second quarter 2020 based on reduced drilling, before considering shut-ins of existing wells that are likely to be needed, with covered company capex, down 35% year-on-year in 2020. Goldman Sachs wrote in a note, eventually, this cut in capex, 35% drop, will mean much higher oil prices in the years to come. Not now, but in the future. However, budget revisions are not over. The slide in spending, drilling, and ultimately in output could deepen as capex cuts grow more pronounced. If you are invested in a resource company, in an oil company, a natural gas company, or a mining company, you need to understand capex, capital expenditures. I talk about it extensively in my mining stock education lecture series, which is free on my YouTube channel and under the playlist Mining Stock Education Lectures. Also in an extensive article I just put out about silver miners and the costs of silver miners for my Patreon account contributors. My over 500, I think it's over 600 now, Patreon account contributors. It is growing very rapidly at only $5 a month. There is no sugarcoating in it. U.S. oil field activity will collapse with oil prices well below $30 a barrel WTI. Raymond James said last week, the initial round of cuts put spending at about 45% below 2019 levels. The bank said, however, the declines will be far more dramatic than these initial cuts, and we stress that these announcements skew towards large cap, better hedged, and capitalized operators. Some of these companies that are hedged, the hedges are going to run off depending upon how long this oil bear market, this record-setting oil bear market, this perfect storm of bad news goes on for. Total U.S. capex is likely to fall in excess of 65%, with a WTI price persisting in the 20s, the investment bank concluded. If they cut the capex price that much, I mean easily a couple years from now, when demand levels get back, we're going to be at $100 a barrel oil. If demand goes anywhere near the levels prior to the global pandemic, there's going to be so little investment, so much production is going to be turned off. There's going to be so little investment in finding more oil. It's going to be a mess, too. You heard it here first that I warned you. Well, I've been warning people that eventually, a couple years from now, this will mean triple-digit oil again. But in the short term, we're going lower. I mean, look, the charts are just absolutely ugly. Rystad Energy put out a similar estimate on Monday. Exploration and production companies are likely to cut project sanctioning by up to $131 billion. Damn. Or about 68% year-on-year, according to Oslo-based firm. Upstream players will have to take a close look at their cost levels and investment plans to counter the financial impact of lower prices and demand. Companies have already started reducing their annual capital spending for 2020, says Audun Marchinson, Rystad Energy's head of energy service research. It's anybody's guess how low WTI and Brent go? Well, the oil majors expect $10 a barrel now. But more than a few analysts have pointed to the potential for storage to max out as a reason why prices have more room to fall. Quote, no one can exactly be sure that production will be shut in fast enough to not overwhelm our ability to store oil, JBC Energy said in a note. The firm pointed to refineries cutting processing because they are running out of storage, such as Exxon's Baton Rouge. Quote, in such an environment, it is as possible for Brent prices to briefly go to $10 per barrel as it was back in 1986 or 1988, JBC concluded. Crazy. And Bloomberg put out an article a couple days ago that was updated yesterday. It was originally on March 27th by Javier Blas and Sheila Tobin. One corner of the U.S. oil market has already seen negative oil prices. It is in a part of Wyoming. And oil refiners are slashing how much they produce like crazy. Again, we are witnessing history. I have covered a lot of oil market busts in 2008 and 2013 to 16. Those are the bear markets I've been in personally in oil. I've studied a lot of the other ones to research the oil market. I've never seen anything like this. This also shows that China is not 100% back online. If China was 100% back online, demand for oil for China would be helping stabilize the oil price. Wouldn't also the Chinese government be buying a lot of oil? That's my opinion. Okay, we have almost 500 people watching this live stream and only 73 likes. I know I focus on the content, but please smash the like button. I'm not getting any new YouTube channel subscribers, really. Only like 100 or 200 or something like that in the last month or two. But at least you can smash the like button. I appreciate it. Thank you. Okay, let's take a look at the Super Chats. A Patreon account contributor, Justin, is here. Thank you, Justin, for chipping in with the Super Chat. Much appreciated. This is a good question. American Expat asks, what are the chances the oil producers all shut down together due to the global pandemic for a month or two? It depends if they have debt. If they have a lot of debt, they can't shut down. So you'd have to look at an individual company. Like a Chevron would be able to withstand this, maybe a Royal Dutch Shell, some of those companies, some of the higher cost shale producers that have hedges and have too much debt on their balance sheets, they can't cut production. Super chat from Greg. He says, thank you for the good info. Keep up the good info. You're welcome, Greg. Thanks for the super chat. If oil gets down to $10 a barrel and we have some dividend cuts, I would start to think about, I wouldn't buy any large positions, but I would start to think about maybe Chevron and Royal Dutch Shell. Or EOG Resources, or I was reading some research from Dan Steffens, who I've interviewed in the past about the oil market. He's always bullish oil. So even before oil prices crashed a couple of months ago, he was still bullish oil. Like, I was arguing with him about the Chinese economy, and he was still bullish oil a couple months ago. That I thought the Chinese economy was slowing down a lot, and he didn't think so. He thought oil demand was going to keep going up. So, like I said, he's a perma oil bull. But he put out a research report recently saying that Parsley Energy has cut costs a lot, and I think they have a good balance sheet, but I'm not buying any oil stocks right now. I mean, I may watch some of these companies, but I'm not buying anything. We are nowhere near the bottom. That chart just keeps gapping down every couple weeks. You can see the chart there on your screen. It's gapping down fairly frequently. We had the big gap down when the first week of March. So the big gap down went from $44.70 down to what? Under 28 in only a couple days. Then we had another gap down March 17th through 18th, a little bit of a rally. Then another gap down March 20th to March 22nd. We were going in a trading range with a little bit of a rally for the last 7 days, but today, oh boy, well tonight, not good. It's going to be some very difficult decisions coming up for all these oil companies. All of them. Okay, I'm looking at listener questions and comments. Otherwise, I'll wrap up the stream a little bit early. I wasn't planning on doing this, but the oil market is crashing again. And then Zero Hedge just reported, I think, that Capital One Bank got a bailout tonight, sometime today, on Sunday. And I saw new articles about how the mortgage banks, the retail mortgage banks that issued a lot of retail mortgages, residential mortgages, excuse me, they need bailouts. I'll do this on a separate show. There's just too much to cover. Christopher Whalen, the institutional banking analyst, wrote an extensive piece in the last week or two about how the basically the entire financial the mortgage finance industry all broke in the last 3 weeks or so. Everything's breaking. The hedge fund guys probably already rented out oil tankers, probably thinking that the bottom in oil was in, so they probably already rented the tanker space. I mean, Goldman Sachs and other investment banks and hedge fund people have been doing that for a long time. Anytime they think the oil price is low, they start renting out tankers. But my educated guess is they probably screwed the pooch and messed up the timing of this. No, I don't think oil tankers are a good investment right now. Oh, Venezuela is ousting the Maduro regime on Bloomberg TV. Oh, that's interesting. I didn't see that. Last question here from George Cortez. Is the Fed going to bail out U.S. shale, or are they out of funds? The Fed is never out of funds. In theory, they can print unlimited. You've heard Jerome Powell recently reiterate that. You heard Steve Mnuchin about 2 weeks ago say they had near unlimited or near unlimited liquidity. Yet James Bullard, the vice president of the Federal Reserve, say the same thing within a couple days as Steve Mnuchin. The Fed has plenty of ammo, plenty of liquidity. I just don't think right now the Democrats in Congress would approve that. So I think that's why I haven't read through the bailout package from Congress, but I'm pretty sure Shale's not in it. Even the cruise ships companies were not in the bailouts. I was pretty shocked at that. Their lobbyists must suck. The lobbyists for the cruise ship companies must really suck. Either that or they with social distancing they can't have lavish parties with cocaine and hookers and a bunch of other crazy shit. Because normally the lobbyists can get stuff like that done. I mean, I live right outside of D.C. If you're not familiar with me, I've lived outside of D.C. for 20 years now, and I met lobbyists. My sister used to be best friends with the daughter of like the head lobbyist for General Motors. So I've heard some stories in my day. I used to do college partying with some of the lobbyist kids. These kids are spoiled brats. Yeah, so as of right now, Shale got a little off tangent there. As of right now, Shale I don't think is getting a bailout, but I would not be surprised. This is a train wreck. We don't know when the train's going to go over the cliff or it's going to run out of track, but this is a train wreck coming. You don't have to be a rocket scientist to predict this. Okay, well, I want to thank everyone for listening to the short little update. Some of the articles I discussed, including the article I read by Nick Cunningham, oil majors are preparing for $10 oil. Crude oil futures slide as the global pandemic darkens demand outlook. Oil futures in record contango of over $10 for the first time since 2009. OPEC nations howl for mercy as Saudi Arabia-Russia oil war deepens. Russia state oil company Rosneft, in sudden move, sells its oil assets in Venezuela. And one corner of the U.S. oil market has already seen negative prices. All those articles will be below this video in the information. Links to those articles will be below this video in the information and description section. Again, thank you very much to my over 500, now over 600 Patreon account contributors. Things are growing very, very rapidly. Seems like I was barely over I was like 500 a couple weeks ago. I think I actually was only at 500 a couple weeks ago. That's how quickly everything is growing. Thank you to my Patreon account contributors too. I still have a few of you guys left, although most of you guys have switched and gals have switched over to Patreon, which is fine. There's a lot of value behind the paywall there, with audio podcasts, well-written research articles, technical analysis on charts, a bunch of stuff. There's hours of content behind the paywall. And thank you for people chipping in and sending me one-time donations and tips so I can focus on content, research, analysis, information, and financial education just like this. So the oil market, final thought here. Oil market's not going to hold 20. This week's, unless there's some type of miracle, this week's could be pretty bad for oil. We're already bad on the futures market, but we could be way below $20 a barrel by the end of next week.